So over the last 6 weeks, the stock market went from hero to zero. We've seen a major move in equity markets. We've seen a major move in global economics, and we have seen a lot of the world shutting down. This is unprecedented. We've never seen this happen before at this level and so fast. But I think it's always important to be prepared for, well, continuation. Will we go back up? Are we going to get back to normal? Or are we going to see a move down in the market? In this video, I'm going to walk you through a comparison to the last two recessions, the tech bubble, the financial crisis, and where we are at today, and the similarities between the three. The other part, I'm going to talk about a leading indicator to what is possibly to come in the equity markets. That's the bond market. In this video, I hope you'll take away the opportunity to reassess your portfolio and to apply possible risk management strategies.
All right, so this is a chart of the S&P 500 going back to mid-1995. And as you can see, we had a major move in the S&P 500. Primarily, it was the tech bubble, the tech blow up, which eventually became the tech bubble. And what we saw is a head and shoulders formation. This being the left shoulder, this being the head, and then this being the right shoulder, which was lower than the left shoulder. And that is a indication that we would continue to see a level of downturn going forward. So we saw that it resulted in a 38% top to bottom downturn, so a loss of 38%. And then that's when the market, became about housing and low interest rates, and we saw the market move back up, and we saw a similar pattern form in mid 2007, and we saw the left shoulder form. We got to 2008, particularly October of 2008, where we had the head form, and then we had another drawdown, and then a move back up, which formed the right shoulder being lower than the left shoulder, and we saw then a move down towards the bottom of the back in, I believe it was just before April of 2009. So a top to bottom move of 58.78%. So it's a pretty sizable loss. Well, the thing that got interesting was quantitative easing and the federal government lowering interest rates fairly low, making money available and cheap, and bailing out banks, and we saw a boom. And we saw a little bit of a hiccup during the 13 to 16, but that was a bit of an issue with China. Things mellowed out a bit, and then the market moved higher and kept on going up until the fourth quarter of 2018, where the market formed once again the left shoulder, and then drastically sold off because the Federal Reserve was going to go on autopilot, raising rates throughout 2009. The market didn't like it. We saw a massive sell-off in December of 2018 into January of 19, which then they turned their tone around and basically said, we'll do a wait and see. And the market took off, and the S&P had a great year up until February 19th of this year. And that's when the coronavirus really came into focus in the United States. And we saw a freeze up in the bond market, in particular the Treasury market. People are running to exchange Treasuries for US dollars, which means they're selling Treasuries, and the Federal Reserve stepped in with an enormous amount of money and has continued to do so since then, and the market sold off. They put in 1.3 or so trillion. Market has rallied based on the idea that everything will be good, and we are now again forming a right shoulder. And that head formation in February, we're now forming the right shoulder, and now markets are topping out a bit. And so we're anticipating we will see a move down towards this red line. If we go back to the tech bubble and we go back to the financial crisis, we see something very similar in the downward sloping trend connecting the left and right shoulder areas. We saw that in 2007 to 2009, and then we're seeing it in December or January of 2019, and now in 2020. So we are continuing to see this downward slope, which if we do see retracement, we will probably see a lower low than we did in mid-March. So that is where we're seeing the equity markets going at this point. We're seeing that weakening up in this area, which indicates, based on past events, that we'll see another sell down or some level of this sell down into this area here. So let's go look at the bond market, which I use as a leading indicator for equity markets. And so what this gives you a little bit of knowledge is when yields fall in the Treasury market, and this chart is a 10-year U.S. Treasury. When yields fall, values go up. And typically people move to Treasury bonds when there is fear in the marketplace. And so what we're seeing here is during the tech bubble, at the peak of the tech growth or technology growth from the mid-90s to 2000s, we saw yields fall, which indicated a move from the equity market, which ran up from a big move from 98 up until 2000, and people started running out of technology or equities and into 10-year treasuries and treasuries in general. We saw the yields fall, which then bottomed in 2003. And then we saw the low interest rates, and we saw the financial growth, or the housing bubble inflate. And then that's when we saw a breakdown in 2008 with the financial crisis, and we saw yields, 10-year treasury yields, go down again, and they ended up bottoming in 2013. We then had a run up from 2013 into 2016, which then we had another little bit of a recessionary environment where yields fell again in the 10-year treasury. And then we had what I call the pre-COVID-19 run up, where we had low interest rates, and then 10-year treasury yields went up until 2019, roughly fourth quarter of 2018, where we then saw a sell-off in the equity markets and a sell-off and basically a buy-up of 10-year treasuries, which brought down the 10-year treasury to where it bottomed basically in the first quarter of 2019. Equity markets ran up through 2019 up until February 19th of 2020. Yields did the same on the 10-year treasury, and then we are at present day where markets froze, yields in the 10-year, everybody ran into the 10-year treasury for safety, and we saw yields drop to where they are today in the low 0.67, as low as in the 0.5% of yield area. And what this is telling me is that there is still fear in the marketplace. We're still seeing equity markets, bond markets and treasury yields go down. And when they go down, that means bond values go up. There's a lot of talk about where the future of the 5-year Treasury yield and the 10-year Treasury yield is. And with the situation economically being so unstable on a global mass level, we could see lower yields in the 10-year Treasury and 5-year Treasury. I mean, any Treasuries, to be honest with you, which means there's still fear in the market. Markets will turn when we see yields turn. We saw it here back in 03, 04. We saw that move up in the the housing growth from 03 to 07. We then saw yields bottom again in 09 and yields move up and equity markets went back up. So the bond market is really a great leading indicator to what is to come. And what it's telling me today down in here in this, 0.5% land in 10-year treasuries is that markets still have a lot of fear in them, and we potentially could see equity markets continue to sell off.
So there are three things you need to consider over the next coming year. Number one, check your risk tolerance. How close to needing that money are you? How risky is your portfolio? Are you allocated in a proper way to meet your needs in the coming 12, 24 months? Number two, stay diversified. Okay? Stay diversified. As you can see in that bond analysis that we saw there of the 10-year Treasury, we see that bonds can be a safe haven during risky times. But there are also different types of bonds that could be, well, more risky. So understanding your diversification model is very important. And number three, dollar cost average into this market. I mean, this stuff is going to get cheap. I mean, buying great companies at discounted prices is a great way to grow your wealth over the next 5-10 years. This is when millionaires are made, buying low and selling high. If I can be of any help to you, feel free to reach out to me. Hey, how about this? I'll do a free risk assessment on your portfolio. Just reach out to me. Click the link below. It'll set up a 20-minute phone call with me. It's an introduction of who I am, who you are, what you're trying to achieve, and see if we can put something together in helping you look at your risk and risk manage your portfolio better. In the end, stay safe, stay healthy, and happy investing.